Hey there everyone, Dave Keller here with Market Misbehavior. Today we're going to answer the question, should we be using adjusted or unadjusted stock data? So I will often get questions about why a chart on a certain platform or with a certain ticker looks a little different than a chart from a different platform or a different ticker. A lot of times, if not always, it comes down to the data and how we're representing it. Sometimes it could be a question of scaling. So it could be using an arithmetic scale versus a log scale. Could be the time frame, right? We're looking at daily or weekly or hourly data or just longer or shorter periods of time. And that, of course, can make the chart look quite different. But there are also some subtleties in terms of the source of the data, right? In terms of where you're getting it from. Now, nowadays, there's a lot of ways to get pretty transparent data, particularly on U.S. stocks. So whether you're getting it from the New York Stock Exchange or the CBOE or the NASDAQ Basic or whatever different sources you may have access to, they're going to be pretty similar because there's a lot of liquidity out there in the markets here in 2023. But there can be a big difference with some of the platforms you use, which you might not be aware of, which is whether they are showing data in adjusted or unadjusted formats. Today I'm going to show you the difference between adjusted and unadjusted stock data, the arguments for using one or the other, what I would suggest you use as a general principle, and what to think about going forward. Before we get there, if you like this sort of thinking about technical analysis, market history, investor psychology, and sentiment, go ahead and subscribe to my channel, won't you? Would love to get above 10,000 subscribers here going into 2024, and excited to get many tens of thousands more, hopefully, after that, as the message of market misbehavior gets around. Also, give the video a like if you appreciate it. We'd super appreciate that back. Before we get to the chart, here's one more thing I want to tell you about. Today's video is brought to you by Seeking Alpha. I find that as an investor, I want to be surrounded by great sources of information, things that will help me cut through the noise and focus on actionable ideas. I'm a big fan of how Seeking Alpha uses what they call their quant rating. They have a great quantitative tool that is available to you as a Seeking Alpha member. In my experience with institutional investors, we would always have an alpha model or a quantitative model, a model that sort of looks at those characteristics of winning companies and shows you stocks that have a similar setup. Seeking Alpha's quantitative model runs on stocks and ETFs, and I find if you're looking through the entire equity universe, trying to focus in on actionable ideas, I'm a fan of using a quant rating like Seeking Alpha's quant rating capability. There's a lot of other great resources there at Seeking Alpha, and if you go to marketmisbehavior.com/Seeking Alpha, I know they have some special year-end deals. Using my link doesn't cost you anything more. It gives me the opportunity to make market misbehavior a little better, so I hope you can check it out. Great gift for yourself here as we set ourselves up for success in the new year in 2024 and beyond. So don't forget to go to marketmisbehavior.com/Seeking Alpha. Let's get back to the charts. All right, so here we're looking at my basic chart of AT&T and on stockcharts.com. And I guess, of course, I use the Stock Charts platform because that's where I spend a majority of my time these days. But I do have experience using a lot of different charting platforms. There are actually very few charting platforms I've not gotten my hands on at some point over the course of my 23 and a half years, including many that are no longer with us, unfortunately. But a lot of the leading platforms I've certainly spent some time with, and there are a lot of great charting capabilities. You remember that years ago, chartists were called chartists, not technical analysts. They were called chartists because a big part of their time, a big bulk of their day, was spent actually updating the charts. Ralph Ekampora, one of my mentors, said he used to call himself a chartist because 90% of the time he was just updating the charts. The other 10% of the time was actually doing the analysis. So, how times have changed. And luckily, platforms like Stock Charts give you and I the opportunity to focus a lot of our time and attention on analysis and finding relationships and actionable ideas. So with that in mind, when you bring up a stock like AT&T on the Stock Charts platform, here I'm doing a 2-year daily chart. I have the 50 and 200-day moving averages. I have RSI below that, and then I have relative strength, which is a ratio of the stock versus a benchmark in the bottom panel. And this is kind of my default chart that I use on Stock Charts, and I bring it up a couple hundred times a day, I'm guessing, looking at different stocks and ETFs. And this is kind of my go-to starting point. Now, here's what AT&T has done over the last 2 years. But you may be surprised to know this is not actually what AT&T has done. Well, I guess it depends on how you want to describe what it's done. If you look back at AT&T's price, let's just pick out a point here, like in the end of May. AT&T actually wasn't trading at exactly 1925 or 1950 at this point in time. This is an adjusted data set. And what adjusted data does is it basically says every time a stock like AT&T publishes a dividend or posts a dividend, there's actually an adjustment to the stock price, right? So when a company pays out a dividend, they pay you 25 cents a share or 10 cents a share, whatever the dividend is, and literally the price of the stock is reduced by that amount of the total payment. And so all the stockholders basically have their stock price is a little bit lower, but they're paid out that difference in a form of a dividend. So they're paying you a portion of the value of the shares outstanding as a dividend payment. So what happens is every quarter or every month, depending on what type of thing you're looking at, the price of the stock will just gap down a little bit because that's the dividend payout. Now that creates a lot of weird gaps on the chart. You can find that on a platform like Stock Charts, by the way, by adding a little underscore in front of the ticker. So if I do underscore T, I'm actually taking those dividend adjustments out, and I'm actually looking at the actual prices that the stock traded at going back in history. So this is a proper representation of where AT&T was trading. So back here in June, July, we're actually around $21 a share. If you do the adjustment, we've adjusted it down to around $19.25, and that's because as the stock pays these regular quarterly dividends, the prices reduce. And so this unadjusted data set shows you those adjustments. Now, you actually can show this, and again, I'm showing this through the lens of Stock Charts, but other platforms, of course, have this capability. So I'm adding in an overlay called Events, and I have an indicator here called Dividends, and I'm going to get rid of some of these other indicators just to clear things up a little bit. Here we go. So if we update it, now we are looking at that little adjustment. So these bars, and forget that little spiky thing. That's a different. That's a split that it's showing, or a corporate structure, a capital structure adjustment. But these little guys here are quarterly dividend. You can see on the bottom here, these dots represent the quarterly dividend. So nowadays, used to be about twice this much in the 50-cent range. But right now, AT&T in 2023 has paid a quarterly dividend of around 28 cents a share. So for every share of AT&T you own, you get a payment of 28 cents once a quarter. And these are the dates at which those payments occur, the X date as they call them. So here are the dollar values just indicated on the chart. So you can see every time there's a dividend payment, you can see that there's a gap lower on the stock. And that's not because people were getting nervous and sold the stock off from one day to the next. That is just partly an artificial adjustment because part of the value of the stock was paid out as a dividend. Now, if we go back to the adjusted data set, so just do the letter T with no underscore, you can see that those indicators are still here, but there aren't those gaps that we saw in the previous chart, right? They kind of overlay because what happens is when the stock is paid a dividend, where the stock company pays out a dividend, all the historical prices are adjusted down a little bit to match the new price of the stock, right? So we adjust the historical data. So that's the difference between an adjusted data set, which on a platform like Stock Charts is actually the default setting when you have a ticker, or the unadjusted data set, where you do underscore in the ticker and then it takes those dividend adjustments out. You should check whatever platform you're using. Other platforms all have very different ways of handling this. Some default to unadjusted data and you can adjust them with something. Some only provide one or the other. There's no real industry consistency. There's no big conference everyone gets to make an agreement. It's sort of up to each platform to default to what they want to default to. So why on a platform like Stock Charts do you default it to adjusted data if it's kind of changing history every time that you do it? Well, here's the reality, right? When you're bringing up a stock, what we had found years ago, and this is before I was a part of Stock Charts, but years before that, Chip Anderson, Stock Charts' founder, talked with John Murphy, who's the chief technical analyst at Stock Charts, has been for decades. And in the discussion with John about adjusted versus unadjusted data, John said, listen, I want to make sure that my technical indicators are a good representation of investor behavior and not anything else. I don't want some dividend adjustment clouding my RSI or MACD or moving averages. I want it to be purely based on the price action. So by adjusting the data, you're eliminating those capital structure changes, right? Dividends and things. and you're just focusing on the trends themselves, just the buyers and sellers and how they move. So when you adjust all the data, your moving averages are based not on artificial gaps because of dividends, it's just buyers and sellers and how that's changing. RSI, which is based on daily closing data, is based on an adjusted data set. So again, it's the momentum based on the behavior of investors and not something else. When you use an unadjusted data set like this, and you look at an indicator, the indicator is not just telling you about buyers and sellers, it's also being adjusted downwards occasionally because of those dividend payments, right? So when you're looking at the RSI in an unadjusted data set, it's a little bit disconnected from investor behavior. So why would you ever want to use an unadjusted data set? Here's the thing. If you're looking at Fibonacci retracements, if you're trying to do some sort of analysis based on support and resistance, then using an unadjusted data set is the much better option, because you want to be looking back at where the stock actually traded at a particular point in time and make sure that you use as much precision as you can reasonably available to make that assessment. Because if you're using Fibonacci retracements on adjusted data, it's not really a great representation of where a stock was actually trading at a historic time, particularly if you're looking at a longer period of time. We'll come back to that in a second. So if your analysis is based on support and resistance and particular price levels, like Fibonacci retracements, unadjusted data is a much better option. If you're looking at indicators like RSI and moving averages, and that's your primary thinking, if you want to look at relative performance and think about what owning AT&T meant for you versus owning something like the SPY, then you probably want to be using adjusted data, just using the regular ticker on stock charts, because that is really showing you what your experience has been as an investor on a total return basis. Now, I should point out two final things about adjusted versus unadjusted data. Number one, this is really only a thing for companies that pay a dividend. So on stock charts, we show this field called yield, which is the dividend yield. So right now, based on the amount of the quarterly dividend, or really the annual dividend total, and the price of the stock, you're yielding about 6.7%. So for every $100 that you invest in ATT, you're getting an annual dividend of around $6.70 from that $100. So that's the yield that you're getting from your investment based on a dividend payout over the course of the 12 months, is what that's basically estimating based on the trajectory of the dividend payments. So for a lot of technology companies, a lot of growth companies, they don't have much of a dividend, if any dividend, right? So a stock like Apple, 0.5%, a stock like Amazon, zero dividend, right? NA, right? So it doesn't pay a dividend. A lot of growth companies don't. So as a result, the adjusted and unadjusted data sets are identical because there's no quarterly dividend adjustment to be had. The other thing to remember is over a longer period of time, that's where things start to get really different. So if you look at like a weekly chart for the last 5 years, here's what the adjusted data set looks like for AT&T. Here's what the unadjusted data set looks like. See how the unadjusted data set is sloping downwards for the last 7 years, while the adjusted data set is more sideways. Still down a little bit, but not nearly as much. That's because those quarterly dividend payments are a big part of the overall return profile for AT&T. It hasn't done particularly well on a price basis. That's what underscore T will show you, because you're looking at just the pure price. And when you take the dividends out, you've actually been losing pretty consistently over the last 6 or 7 years. But when you add that healthy dividend in there, you're actually more flat for that period, because those dividend payments are a big part of the story. It's not a growth company, right? AT&T is more of a blue chip established name, but overall that income component is pretty compelling. So long story short, adjusted or unadjusted data, I would argue there's no right answer. I think the right answer for a particular time is really specific to you and what type of questions you're trying to answer. If you're focusing more on price, on support and resistance levels, and particularly enter and exit points based on price on its own, unadjusted data is probably the right answer for you, generally speaking. If you're focusing more on a long-term time frame, if you're focusing more on an income component to your investment strategy, and you want to analyze, use indicators, you're analyzing the price behavior, the investor behavior, and not capital structure changes, then adjusted data makes more sense. I have found I use them interchangeably. There are times when I'm analyzing price and I use the unadjusted data set. There are times when my go-to default where I'm just trying to analyze a particular chart and what it means on a total return basis. Using the adjusted data set makes sense. Best thing, though, is to be aware of what data you're using and make sure that it's helping you answer the questions you are asking at any given point. Does that make sense in terms of adjusted versus unadjusted data? What sort of examples do you have of where that makes a big difference? Drop a comment below and let me know if you have questions on this that I wasn't able to get to in this video. What other videos can we talk about on market misbehavior in 2024 and beyond? Drop a comment. Let me know what sort of subject areas you'd like me to hit on in focusing on technical analysis, behavioral finance, investor psychology, market history. I'm excited to keep this channel going and growing and would love your help pointing me in the right direction. For Market Misbehavior, I'm Dave Keller. Have a great holiday season. Wish you the very best, and I'll see you again in the new year. Bye-bye.